Hello everyone. Welcome back. Today, we've got some crucial news you don't want to miss. Let's dive right into the top financial headlines and break down what's happening. Today, we're sharing an insightful report from the Bloomberg titled Goldman, BlackRock warn Europe's stock rally faces tough hurdles. The article highlights the challenges European markets will encounter despite recent gains. European stocks hit a record high last week, but experts caution that maintaining this momentum into 2024 will be difficult. Fund managers from Goldman Sachs, BlackRock, and Northern Trust are warning investors to brace for a downturn, as economic sluggishness threatens corporate profits. Additionally, the upcoming US elections add another layer of uncertainty as the market prepares for a turbulent final quarter. What looked like an unstoppable rise in the first half of the year has shifted to a pattern of peaks and valleys over the last 3 months. While China's long-anticipated stimulus measures could provide new momentum, analysts suggest that the bar for significant stock market gains is set quite high. BlackRock's report notes that the market is particularly sensitive right now, given the unpredictable nature of the US elections and the uncertain macroeconomic outlook. Northern Trust has downgraded its outlook on European equities from overweight to neutral, citing concerns about the macroeconomic environment. The firm's chief investment officer, Bahugana, remarked that economic data appears unstable. While inflation is declining, it's not dropping fast enough to signal substantial relief on interest rates. This creates an environment where taking risks seems unwise. The article also analyzes 2 external factors affecting the European market. First, the implications of the US elections could have a significant impact. If Donald Trump wins, his proposed 10% import tax and increased tariffs on Chinese goods could lead to a full-blown trade war, putting additional pressure on European corporate earnings, particularly for stocks in Germany and Italy, as well as industries like capital goods, automobiles, beverages, and chemicals. The second external pressure is the influence of China. The report suggests that a series of stimulus measures from China might be just what the Stoxx 600 index needs to kickstart a year-end rally, considering that about 8% of corporate revenues in Europe come from China. Analysts from Barclays and Citigroup note that China's efforts have bolstered the outlook for cyclical stocks like those in mining and automotive sectors, which have lagged behind defensive stocks for most of the third quarter. In fact, the basket tracking European cyclical stocks surged by 3.2% last week, while defensive indices remained flat. However, the anticipated improvements from China's stimulus have yet to yield meaningful results, leading to skepticism about its effectiveness in revitalizing consumer sentiment. This skepticism is especially relevant for European luxury brands, which depend heavily on Chinese consumers. With economic challenges prompting consumers to shift toward discount brands, the industry reliant on China for up to 20% of its revenue is feeling the impact. From my perspective, there's a significant driving force behind the US market, the Federal Reserve's entry into a rate-cutting cycle. Meanwhile, China is rolling out aggressive stimulus measures. In contrast, Europe appears to lack any exciting external factors. The article's analysis of the 2 main external influences on the European market prompts me to question the impact of the US election. I see this as a hypothetical scenario rather than a real threat to European markets, as any actual effects would likely only materialize after the November elections. As for the influence of China, this is indeed worth paying attention to. The focus on consumer sentiment in China is critical. Whether the recent stimulus can improve consumer attitudes remains uncertain. Both Goldman Sachs and BlackRock seem less optimistic about the impact of China's stimulus on the real economy, believing it may primarily boost the capital markets without significantly benefiting the underlying economic conditions. This analysis suggests that continued sluggish consumer spending in China could dampen the outlook for European markets. It's a fascinating observation. Of course, when major Wall Street firms provide direction, they have their own interests in mind, which may not always be publicly disclosed. We should remain cautious and consider their insights carefully as we navigate these complex dynamics. The second major news story we're discussing today comes from CNBC, with the headline, "Iran's response to Israel will be a choice between revenge and survival." Markets say it's choosing survival. This report is particularly interesting and worth paying attention to. As I shared yesterday, the fluctuations in international oil prices will largely depend on the evolving conflict between Israel and its neighboring countries. Recently, Israel targeted and eliminated the top political leader of Hamas, and Iran has vowed revenge, but so far, that retaliation hasn't occurred. Instead, Israel has also taken out senior leaders of Hezbollah, which is supported by Iran, including a high-ranking member of the Iranian Revolutionary Guard. This escalation raises the question of whether Iran will continue to endure these attacks without responding. CNBC analysts suggest that Iran might opt for restraint this time. The report explains that Iran's extensive network of proxies in the Middle East has faced repeated assaults from Israel. The recent increase in military engagement with Hezbollah has seen Israel conduct airstrikes in Beirut, resulting in the death of Hezbollah's longtime leader, Hassan Nasrallah. Hezbollah has been a key strategic ally for Iran since its establishment in 1982, and Tehran has heavily supported and nurtured this militant group, making it one of the most significant non-state armed organizations in the world. While Iranian leaders, including generals and Supreme Leader Ayatollah Khamenei, have promised retaliation, their actions so far indicate a more cautious approach. A full-scale war between Israel and Iran could have devastating consequences for the entire region, particularly for Iran, which is already struggling with a weak economy and vulnerable infrastructure. Should Iran directly engage in conflict, it would make the country an obvious target. Therefore, survival takes precedence over revenge, especially in a war of attrition. Iran has shown restraint, as its economy has been battered by years of severe Western sanctions, mismanagement, and rampant corruption. High inflation has eroded the purchasing power of its citizens, making basic necessities increasingly unaffordable amid the severe devaluation of the Iranian rial. Analysts note that a nation of nearly 90 million people simply cannot afford another war. This report helps us understand how the situation in the Middle East may unfold. Will Iran continue to hold back? Throughout this year, Iran has faced a series of setbacks on the world stage. From significant attacks during the commemoration of General Qasem Soleimani's assassination to high-ranking officials losing their lives in various incidents, and the recent targeted killing of Hamas's top leader in Iran's capital, these are all substantial losses for Iran's strategic interests. If Iran were to truly engage in a large-scale conflict with Israel, it could lead to a complete breakdown of stability in the Middle East. However, the analysis from CNBC offers a glimmer of hope for the markets. It suggests that the Iranian leadership might choose to endure these provocations for now. As we continue to monitor these developments, it's essential to remain aware of the complex dynamics at play and their potential implications for regional stability and the global economy. The third major news story today also comes from CNBC, titled "Here's Why Japan Stocks Are Plunging After Shigeru Ishiba's Win." It's quite straightforward to predict that the Japanese stock market would fall after Shigeru Ishiba's election. The reason is simple: Ishiba supports raising interest rates at the Bank of Japan, BOJ, which contrasts sharply with former Prime Minister Shinzo Abe's legacy. Abe's economic policies, known as Abenomics, were centered around monetary easing and low interest rates. Therefore, Ishiba's election naturally triggered a market reaction. CNBC provides an analysis of this situation. But is this simple cause and effect truly reflective of the market's reality? The article explains that the primary reason for the market's dissatisfaction lies in Ishiba's stance on interest rates. A well-known investment manager from a prominent Japanese firm commented that raising rates now is meaningless. Recent data shows that Japan's industrial production dropped by 4.9% year-over-year in August, a steeper decline than the previous month's 0.4% drop. On a monthly basis, production fell by 3%, significantly worse than the median estimate of 0.9% from a Reuters poll. Given the clear downturn in Japan's economy, raising interest rates would undoubtedly worsen the situation. This disconnection from reality, focusing on tightening monetary policy instead of supporting a struggling economy, is why many investors are resistant to Ishiba's views. The second point raised in the article is particularly intriguing. It suggests that China's economic rebound could put pressure on the Japanese market. Normally, a rebound in China would be seen as a positive influence on neighboring countries. However, the report cites an investment manager from Magellan Capital, who argues that Japan is viewed as a counterweight to China in trade. Therefore, when China performs poorly, Japan's market tends to thrive. With the recent shifts in sentiment and stimulus measures from China, Japan's market may face pressure as a result. This perspective is somewhat dramatic and lacks a clear logical explanation, but it's certainly interesting. The negative correlation between the Japanese and Chinese markets isn't necessarily a hard and fast rule, but it could be a phenomenon observed during certain periods. Overall, this analysis sheds light on the complexities of Japan's economic landscape following Ishiba's election and the broader implications for the stock market. It's a fascinating discussion that invites us to consider how intertwined these economies truly are, especially in the context of regional dynamics. The fourth major news story we're sharing today focuses on two significant developments in the global artificial intelligence landscape. While you don't need to be an expert in every field, it's essential to be aware of events that have a major impact worldwide. First up, OpenAI is undergoing a significant transformation. Historically, the company operated in a gray area between a non-profit and a for-profit entity, but it's now taking steps to fully embrace a profit-driven model. This shift marks a major change for one of the leading companies in advanced AI, drawing considerable attention. In addition to this shift in focus, OpenAI has experienced a shakeup in its leadership. Aside from CEO Sam Altman, all core executive team members have departed the company. Altman is currently negotiating for a 7% equity stake, aiming to benefit from the anticipated rise in the company's stock as it transitions to a for-profit model. These developments highlight OpenAI's push toward commercialization, sparking debate about whether this is beneficial or detrimental to the company's future. The second major story in the AI sector is Google's bold move to spend $2.7 billion to rehire AI prodigy Noam Shazeer. This significant investment has raised eyebrows amid discussions about whether tech companies are overspending on AI talent. Shazeer, who previously worked at Google, left the company in 2021 after it chose not to release a chatbot he developed. Following his departure, he founded his own startup, which is now struggling. With Google's hefty price tag for Shazeer, there's considerable debate within the US AI industry about whether this decision is justified. The Wall Street Journal quotes Stanford AI Lab director Manning, who questions whether Shazeer's contributions will truly justify the $2.7 billion investment, asking if he's 20 times better than others in the field. On the other hand, former Google CEO Eric Schmidt offers a contrasting view, praising Shazeer's potential to create human-level artificial intelligence. This differing perspective underscores the intense competition for talent in the AI sector, which remains in a phase of high investment. These stories illustrate the dynamic and competitive nature of the artificial intelligence landscape in the US. As companies continue to invest heavily in talent and technology, the race to advance AI capabilities is heating up, making it a critical area to watch. That's all for today. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more updates. I look forward to seeing you in the next one.